My biggest fear of all of this is it's kind of like a psyop, like a setup, and they want to blow up the system and blame things like, free market capitalism and Trump, of course, and all of his policies for blowing everything up. And I don't think people understand just how screwed up the books really are, and the lying that we get out of the Bureau of Labor Statistics on unemployment and on inflation and just how bad it truly is.
A major talking point among financial analysts who focus on alternative assets, particularly in the precious metals industry, is the urgent need for investors to move out of the traditional financial system before a potential collapse strikes. Many warn that the debt-based fiat monetary system is nearing its breaking point, with an inevitable downfall looming. Gold analysts frequently emphasize the phrase, "get out of the system," to highlight vulnerabilities within the global financial framework and conventional investments. These concerns include relentless currency debasement, soaring government and corporate debt levels, potential bank failures, geopolitical instability. Analysts fear that fiat currencies could lose their value due to persistent high inflation or aggressive monetary policies like quantitative easing. They argue that holding assets such as gold, which has intrinsic value and centuries of history as a reliable store of wealth, can act as a safeguard against currency devaluation and economic instability. Furthermore, the staggering levels of global debt, currently exceeding 300% of global GDP, underscore how poorly today's governments and policymakers manage financial responsibilities. This has eroded trust in traditional financial instruments and driven many to see gold as a more secure alternative. In a recent conversation with Stacking Surfer, Andy Schectman, a well-known bullion dealer and president of Miles Franklin Precious Metals Limited, highlighted the urgency of moving out of the conventional system. He explained how to do this thoughtfully without completely isolating oneself from society. Schectman warned that global elites may intentionally disrupt the system to safeguard their own interests and make the public more accepting of central bank digital currencies, CBDCs. He believes this significant upheaval could begin during Donald Trump's presidency and urges those investing in precious metals to act before the situation deteriorates. We'll be sharing clips from Andy Schectman's insightful interview, where he discusses the state of the U.S. economy, the weaknesses of the fiat system, and the value of alternative assets like gold and silver. Be sure to watch until the end, like and share this video, and subscribe to our channel. Don't forget to hit the notification bell for updates on more valuable content. Thanks for watching, and enjoy the video.
I think it's not that bad. I'm sure there are people that are concerned and bummed out by it. It's better than the alternative. I think that this administration will be much better for the country, but it will ultimately be very good for gold too. Look, when Trump won in 2016, gold sold off hard for a few weeks until mid-December. But following that, there was a huge gold rally through much of 2017. You have a situation where there's been massive short positions by the commercial banks across the board in gold and silver that have been literally bleeding them dry for the better part of the last year. And this was an opportunity on the Trump euphoria to push the price down a little bit to get the algorithms to start selling, which then triggered a pretty large sell-off. And what you're seeing is the managed money that was very long has sold a large portion of that position, which means the commercial banks go the opposite direction. Not only are they covering their shorts, they're taking the longs on the other end. This is to be expected. I was wondering how these banks would ever get out of these short positions, and I think this is an opportunity for them to do that. But in terms of, where this is ultimately going, I think nothing has changed at all. In fact, look, Trump is a proponent of very low interest rates. I mean, he'd like negative interest rates if he could. During his last tenure, he was calling the Fed boneheads for not implementing zero or even negative interest rates. And so when you talk about a situation of lower interest rates and a weaker dollar, that's bad for the purchasing power of the currency. Certainly that's good for the banks, that's good for Wall Street, but it's also very, very, very inflationary. What happens is that lately, as the front end of the market, the bond market, the yield, the rates have been pushed down, the back end's going up commensurate, if not more. In fact, they've lowered the front end by 75 basis points, and the back end is up over 80 basis points over that same period of time. In other words, the 10-year treasury, which is the most important treasury. It's the one that is tied to the mortgages. It's tied to the credit cards, to the auto loans. It's tied to leases, commercial leases in terms of real estate. So yeah, I think that this was to be expected, and it shouldn't shock people. And to see it move in the direction that it is going, when you see the stock market and cryptocurrencies taking off the way that they have, again, it's only exacerbating this correction, which is really something that the big commercial banks, I think, are welcoming. Now, at the same time, where this becomes kind of dicey is that you have half of the world looking at these depressed prices as an opportunity to load up on gold and silver at subsidized prices, that being the central banks and the BRICS nations. So yeah, this is the market exhaling and irrational exuberance, if you will, because while this will be good for the country on many levels, it doesn't change the fact that even if you had a guy like Elon Musk come in and trim all the fat, all of it, and we get into a much more streamlined situation with the government, the Congressional Budget Office, which is a nonpartisan group out of Washington, maybe the last nonpartisan group, has come out and said that by 2031, in just 4 years, 100% of tax revenue goes just to pay the interest on the debt and the mandatory entitlements like Social Security and Medicare. And how do you retain your status as the supreme authority in the world, if you will, in terms of militarily and in terms of financially, when you're borrowing things like military spending, which is discretional?
The Congressional Budget Office, CBO, and other financial analysts have raised concerns about the rising share of U.S. tax revenues that will go towards servicing debt due to increasing national debt and interest rates. Current projections indicate that interest payments on the national debt are expected to become one of the fastest growing components of the federal budget. By the early 2030s, interest expenses could consume a significant portion of tax revenues. Estimates suggest that interest costs could take up more than 30 to 50% of federal revenues, which would place significant pressure on funding for other government programs and services. The concern is that if interest rates rise faster than expected, or if the debt continues to grow unchecked, the portion of tax revenues dedicated to servicing debt could escalate even further. This would limit the government's fiscal flexibility and could result in difficult policy choices regarding spending and taxation. Experts like Andy believe these difficult policy choices, a mandatory austerity program, or an outright government default, will lead to the enforcement of CBDCs, allowing governments to debase their currencies further and more easily impoverish the working class. The solution Andy suggests in the interview is exiting the system and being your own bank. Here's how he suggests you achieve that.
So being your own bank, in my opinion, is not as crazy as it sounds. I think that this is the time to do things like that. Unconventional times certainly call for unconventional actions. If I were going to be in any bank that wasn't, I'd stay out of the regional banks. A credit union is probably better than the large commercial banks. They are not as risky as the big banks are, but they're not immune to all the problems either. So yeah, leaving enough in the bank to pay your monthly expenses and whatnot, sure. But any other cash, I think you'd do a whole lot better riding the Trump wave, if you will, the Trump train, or being your own bank and removing counterparty risk that I just have a hard time believing won't rear its head probably very soon. My biggest fear of all of this is it's kind of like a psyop, like a setup, and they want to blow up the system and blame things like, free market capitalism and and Trump, of course, and all of his policies, people understand just how screwed up the books really are, and the lying that we get out of the Bureau of Labor Statistics on unemployment and on inflation, and just how bad it truly is. Most people have no idea, but if you were, like, for example, the liquidity in the system, the BTFP, the Bank Term Funding Program, expired just a couple of days ago. The reverse repo market is down to almost zero. The velocity in money is very slow right now, and the liquidity is bad. And so when you talk about banks in urgent need of liquidity, they have been able to draw upon the reverse overnight repo market. They have been able to go and use things like the discount window or the BTFP. All of these things are down to the lowest levels. BTFP is gone. The overnight lending window is very, very low, and then horrible terms that they don't want to use them. So there's problems in the system, and as rates on the 10-year go higher, that's going to create massive problems as these commercial loans and leases come due this year and next, which then cripple the banks and can just like that, set that daisy chain off in the banking system. So we're not out of the woods, but we should be optimistic. I'm sick and tired of being, Joey Buzzkill. I am. I mean, it gets old, right? But I guess if the foo should swear it, right? So you know what I'm saying? I just think that it's foolish to become concerned and panic-stricken about what's happened right now. This is exactly what happened in 2016, and everything turned right back around, and gold started to march much higher. So just stay true to your beliefs and your convictions. We haven't seen anything that's going to change ultimately the fate of the dollar. But there might be some profits on the table in the stock market and in the crypto market. And I don't think there's anything wrong with riding this wave for as long as you can. Just be careful.
After more than 3 weeks of price declines, gold prices are beginning to recover and have climbed from the low of $2,553 recorded on November 14th to $2,624 on November 19th, reversing half of last week's declines. Gold prices have remained steady for the second consecutive day, supported by the recent pullback in U.S. Treasury bond yields. This dip in yields has prompted a corrective move downward in the U.S. dollar against major global currencies, benefiting gold's appeal. The retreat in bond yields reflects investor caution about the potential impact of fiscal and trade policies that could be implemented by U.S. President-elect Donald Trump, with implications for economic growth and inflation projections. Gold also gains strength amid escalating geopolitical tensions between Russia and Ukraine. Over the weekend, President Joe Biden authorized Ukraine to use American Army Tactical Missile Systems, ATACMS, for strikes inside Russia, signaling a significant escalation in the conflict. This move came in response to Moscow's deployment of North Korean ground troops to reinforce its military. Adding to gold's positive momentum are expectations of additional stimulus measures from China, the world's largest gold consumer. According to analysts cited by the state-run Securities Journal, further cuts to the Reserve Requirement Ratio, RRR, are anticipated this year, which could boost economic activity and support demand for gold. These combined factors, lower U.S. bond yields, geopolitical uncertainties, and potential Chinese economic stimulus, are currently providing a favorable backdrop for gold prices. Do you think the momentum will be sustained for long, particularly as all the contributing factors are still unfolding? Share your thoughts in the comments section below. We'd love to hear from you. Don't forget to like this video, subscribe to our channel, and turn on the notification bell so you don't miss any of our future updates. Thanks for watching, and we'll see you in the next one.